Markets are ripping on the back of a hot jobs report. When good news finally becomes good news for the markets, they started down initially across the board and then have rebounded in the afternoon. We'll see what the close looks like. Still have a couple hours to go to the close, but interesting day on the street today for markets and for Bitcoin and crypto. Let's jump in and take a look. The Dow currently about 2 p.m. EST as I'm filming this is up 1%, S&P up 1.14, NASDAQ up 1.5%. Initially, the markets were down as much as 1% off of the back of the jobs report, adding double the amount of jobs that was expected. And the consensus was, the thinking was, that the markets would tank on a hot jobs report because that would indicate the Fed's going to have to do more tightening. We also have the yields ripping lately, the 10-year hitting highs that we haven't seen in 20 years or since 2007, and maybe even before that. And, that has traders unnerved, but they're shaking that off today. And good news is good news for the day so far. We'll see how we close. Let's jump in and take a look at the charts here. And look at the Dow. We got a nice little pop on the Dow. The NASDAQ, nice little bounce area as well coming in on the area of consolidation. The VIX taking a break. The Dixie taking a break. 2-year up a little bit, but has retreated so far today. The 10-year initially popped up to 4.89%. Let's take a look at what that represents from a time span. Looks like the last time we saw the 10-year at that level, it was 2006, 2007, oddly enough, coming into that 2008, 2009 GFC. But what's really happening is we're just returning to normal with rates, with the Fed funds rate, with treasuries, things like that. We've been on basically zero interest rate, quantitative easing since 2009. And it's time for all of that to get unwound. And that's the message that the market, or that the Fed is sending to the markets, that the financial conditions basically have been loose all along. And they are finally starting to tighten. And the bond market is doing the tightening for the Fed. Coming off of that, the narrative, the markets have been fighting the Fed all the way along, thinking the Fed was going to cut. Every time the Fed hiked and was on the hiking campaign, the markets kept pricing in rate cuts. So the Fed has sternly come out and said, higher for longer. The jobs market confirms higher for longer. Now, the real question is going to be, are they going to hike now because of the jobs market? I think right now they're still in the camp of a pause unless we get a really hot inflation print. I think the Fed's going to kick back and let the treasury market, the bond market, do the tightening, the rest of the tightening for the Fed. Because the Fed doesn't want to accelerate the breaking of something, and the breaking of something could already be happening in the treasury markets. We'll see rates have retreated. Yields have retreated so far today, like I said, but a lot of people looking for 5+% on the 10-year. The higher the 10-year goes, the more damage that's ultimately going to do. The real question is, why are rates rising? Because the economy is still strong, or is it because the bond vigilantes are trying to punish the government for all the debt, or is it just rebalancing the trade where people were banking on treasuries coming down, they got caught short and they got to cover. So a lot of things happening. Let's jump in and take a look at Bitcoin. Bitcoin just kind of ranging in that tight $27,000 to $28,000 range right now, holding up above this trend line that was broken. And unless something happens, Bitcoin could continue to just range in this area for a while the markets, the bond markets, the stock markets, and everything try to work themselves out, because Bitcoin trades with liquidity in the markets like a risk asset, like all of the risk assets. It's a good day for the markets today. Not significantly up, but it's a good little break because markets have been down. Let's take a look at Ethereum, kind of hanging out, doing the same thing. Pretty much everything's following along. XRP unwound that big move off of the ruling from the judge in the SEC, or in the XRP case, the SEC versus XRP, the judge denying their colloquy appeal. So now the SEC has to punt and file for a formal appeal, which is a much longer process without certain outcomes. But pretty much all the rest of the crypto space just kind of running along. If you look at the total 2 and the total 3, basically this could be seen as consolidation, like this area here before the run up in 2020. So if this is a good consolidation area and price holds up in the altcoin markets, that's a good thing. Although there is further downside potentially depending on what happens in the overall crypto market. Same thing with Bitcoin, just kind of consolidating along in this range right now after after this recent drop down to the level, kind of sideways and up a little bit. May come back down and recheck some of this lower level around 20,000 into the halving in April over the next 6 months. And then we all know what usually happens after the halving, or maybe if you don't, Bitcoin usually goes on its bull run after the halving. It consolidates into the halving, sometimes rechecks those prior lows right before the halving. And then after the halving goes off into its bull run cycle. So will this time be different for Bitcoin? Is it going to do the same thing and follow suit? We'll just have to wait and see. But right now, all eyes on the Fed, all eyes on the jobs market. Of course, all that gets revised, so it doesn't even matter. I think that's why the markets are shaking it off. They're expecting revisions. But, it's a good day, good technical bounces, a lot of rebalancing going on with options expiration. A lot of people were short thinking that the jobs were going to come in hot. But we did see the 10-year yield start to bounce before the report was released. So somebody had that news. The administration, Biden, had scheduled a press conference. So I think there was some early indications from somebody letting the cat out of the bag what the jobs report was going to look like. And, right now, this could be ammunition for the Fed to hike, especially if we get a higher than expected CPI. This month, the Fed doesn't meet again until November, end of October, 1st of November. So we have a little bit of time, a little bit more data. We've got earnings and all kinds of things coming out. So it's going to be an interesting time. October can be a dangerous time for the markets. We'll dig into that on the next video, and I will see you then.